Hello, this is MyTime Television exploring United States stocks. This video is being broadcast simultaneously on our MyTime Television channel through a partnership with MyJuyon Television. Right now we are introducing companies related to stock discovery and also continuously filming and sharing segments that are helpful in practice by making good use of our choice stock. Today's video is a follow-up to the previous one where we talked about stocks with a sharp rise in earnings per share and explained that you should check the direction and speed of earnings per share. So if you look at the speed and direction of earnings per share, you can broadly divide them into three categories. One is when a company turns profitable, meaning its earnings per share shifts from negative to positive. In today's video, I'll cover how to find, analyze, and evaluate companies that make this transition. Next time, in the next video, which I have listed below as an example, I will also explain how to evaluate companies with accelerating earnings per share growth rates, and third, how to assess companies that are performing very well this year but are expected to see slower growth next year. So including the last video, today's video, and the next two videos I'll be filming, there will be a total of 4 videos, and you can think of them as one series. So based on the changes and fluctuations in stock prices and earnings per share, I'll explain some practical strategies and how you can apply them in real trading. Today I'll talk about how to identify and approach companies that have turned profitable. First of all, I think it's best to explain with an example, so I've brought some cases to share with you. The company is called Roku, which is a company that turned profitable. Its ticker symbol is ROKU. This company was very hot in 2021 and 2022. Now, as Netflix's stock price has risen significantly, this company seems to be one of the forgotten ones. But in fact, its stock price soared almost tenfold in 2021 and 2022. And then after going through the COVID era, the company underwent restructuring in 2021 and 2022, and its stock price plummeted to about 1/10 of its previous value. Only now is it starting to turn a profit again. The basic model is that this company provides content through its television streaming platform. But what exactly is the role that this company plays? For TVs that aren't smart TVs, you know those USB-like dongles you plug into the back? When you plug it in like this, it lets you use over-the-top services, just like a smart television, so you can access and watch them. That's the kind of service they're providing. Although they make their own Roku TVs, profit margins are not very high. So aside from that, when you turn on the television using the Roku platform, their menu pops up like this. And within that menu, there are quite a lot of free contents that they provide. There are also a lot of free movies. So as people watch these free movies, generating revenue through advertising within this platform makes up the largest part of their business. In addition, they also produce some original content themselves and distribute it through this platform. Also, recently they've created low-cost ad models, which are somewhat similar to Netflix, and they're expanding into those kinds of formats as well. So this service isn't just a simple over-the-top service or a single Netflix. There are also options where you can choose and watch from multiple platforms. They also generate revenue by offering free content and showing ads to viewers. As I said before, advertising revenue is the main part of this company's business model. If you look at the chart on the right, you can see that their revenue has grown very rapidly. That's true, but the green sections show operating and net profit. In 2021 and 2022, revenue rises, but profits fall sharply. The company nearly posted a loss, sparking bankruptcy rumors as both stock price and performance hit rock bottom. Recently, as this part has improved, the securities industry is now expecting the earnings per share to turn positive on an annual basis this year. I'm going to explain how to look at the relationship between stock price and earnings per share for these kinds of companies. If you look at the stock price and earnings per share chart on the left, the right side here is 0, so above that is profit, and the green areas below are where there were losses. Before that, it was all losses, but as it went up like this, it turned a profit for the first time this year, and it's expected that the earnings per share will continue to rise next year and the year after as well. So, in the case of the current stock price, it plunged sharply, then had a first rebound, then dropped sharply again, and now it's at about the level of the previous high. So I'm going to explain what kind of data you should look at to judge whether the stock price of a company like this, which has turned a profit, will go up further. I mentioned in the previous video that just because the valuation is below the earnings per share doesn't mean the stock is cheap, and just because it's above doesn't mean it's expensive. And if you don't quite understand this part, I recommend you watch the previous video and then continue watching this one. I've been asked, if a stock's price is below its earnings per share, isn't it cheap, and above it expensive? Why does valuation differ? Someone asked me that, so I think that person probably didn't watch the previous video. If any of you are confused about this, I recommend watching the previous videos and then continuing with this one. When you look at the recent data, if the expected performance is a turnaround to profit, it's better to check this first. There is the raw data itself, and at Choice Stock we provide this data for free, so you can just come and search for it. Here, when we say earnings per share turnaround to profit, we're talking about operating profit or net profit. If you look at earnings per share, the blue numbers below show minus $5, minus $0.89, and so on, indicating negative values. This means it's in the red, and if you look now, there are values shown above zero, upwards like this. All of these indicate that it's in the black, meaning it's profitable. So if you look at this year, for the first time, it turns a profit with $0.17, and then next year, 2026, it's $0.85, which is almost a fourfold increase. Then the following year, it's $1.90, which is about double compared to $0.85. So with increases of 4 times and then 2 times, you can see that earnings per share is turning profitable and rising significantly. Usually after turning profitable, if you look here, the growth rate is 398% at $0.85 and then 124% at $1.90. That's probably because it doubled. So it appears in this kind of pattern because the value at the time of turning profitable is what we call a base effect, meaning the base is really low. So even if the earnings per share is just a little higher the following year, it looks like the growth rate is really high. So the part that really needs attention is how much attention Locke will get in the market during this period when the growth rate comes out from this year to next year. I think that's going to be a very important point. If you look at the sales, they keep growing at a similar rate, 13, 12, 11. So on average, it's about 12% growth. Compared to that, the earnings per share growth rate is much higher. Until now, sales have grown steadily to some extent, but profits completely plummeted and are now recovering rapidly, regaining past performance levels. Compared to that, the stock price still hasn't recovered much. If you look at the stock chart for the past 5 years, you'll see that recently in 2025, the stock price has risen to about $90 to $100, which coincides with the previous peak. If you look now, this $100 level has served as a long-term peak for about 2 to 3 years. So I think there will be a lot of back and forth around the $100 mark for this company. But if it breaks through $100 with some trading volume, it seems likely that it could move on to the next stage. So it's not like the supply and demand has improved dramatically yet, but those kinds of changes are happening right now. The reason for that change is the turnaround to profitability. I think it's good to see it as being due to this shift to profitability. If you look at the past stock price, in 2022, the highest price was $490. Since it dropped to a low of $38 from $490, that's a drop of more than 1/10. Those who invested at that time probably had to endure losses for a very long time. And I think there are hardly any people who invested back then and are still holding on to it now. So basically, when the supply and demand have completely collapsed like this and there's no rebound, it's better to just cut your losses and watch from the sidelines. Especially since not only was the supply and demand tangled, but at that time, the earnings were also expected to be in the red. So the situation was completely collapsing. At times like this, even if you wait to break even, there's a high chance that you won't get back to your original price for quite a long time. Also, right now, in this case, Rock has turned a profit and recovered, but there are companies that don't recover like this. In those cases, it could drop much further than this, so don't focus on the price you bought at. If you feel it's not right, it's better to sell and look for a more attractive company to invest in next. So right now, this is a point where such changes are happening. So I'm telling you how you can keep checking those things through data. So for companies turning a profit, as I often say, it's really important to look at the cash flow statement rather than the income statement. For profitable companies, operating cash flow becomes positive before net income does. If you want to buy early while the company is still undervalued before net income turns positive, that's what to look for. Then you need to look at the operating cash flow on the cash flow statement and also the free cash flow, which we call free cash flow. So you should pay attention to this indicator called free cash flow. In the case of Luke, if you look at the operating cash flow, this is on an annual basis. It kept going up every year. And then in 2020 and 2021, the operating cash flow peaked, reaching about $200 million. That's why the stock price also rose very quickly. But then, in 2022, the operating cash flow dropped sharply, not just to 1/10, but almost to 1/15 or even 1/20 of what it was. At that time, net profit also turned into a loss, and only the operating cash flow was positive in this area. At that time, the stock price had completely collapsed, but if you look at it recently, it's back to $250 million, $210 million, and this year it's expected to be in the high $300 million range. So, the operating cash flow has already surpassed the peak recorded in 2021, but net profit still hasn't, right? There was some net profit before, and now it's turning profitable again, so net profit will recover with operating cash flow. So there will definitely be moments when net profit surpasses the previous profits, even though they weren't large that were recorded in the past. These are now projected in the securities industry as earnings per share growth rates for 2025, 2026, and 2027. So, if the operating cash flow recovers this quickly, you can consider a company that has turned profitable as a decent company. That's why it's important to look at this aspect first. When we discuss free cash, it's the same. It refers to cash flow from operating activities. After subtracting cash spent on capital investments or essential operations, what's left can go toward investments, share buybacks, or dividends. The cash that can be used freely at the company's discretion, that's what we call free cash. So in Korean, instead of calling it surplus cash, we also refer to it as free cash flow. We use the term free cash flow because free isn't translated as surplus. The term surplus refers to operating cash flow. Out of what the company earns, after spending the money needed for growth, the remaining amount is called surplus cash. So surplus cash flow, free cash flow, and free cash flow all mean the same thing. That's why it's important to check this. In the case of Log, both the operating cash flow and free cash flow have turned around and are improving, so you can see it as heading in a positive direction. Next, what we need to check is the quarterly performance. If you look here, the sales have steadily increased and have reached about $1.1 billion per quarter. However, operating profit is still negative. Losses are shrinking, but in Q2 2025, the deficit remains at $2030 million. And although the net profit is positive, that's because of non-operating income in the middle. In reality, the company is still running an operating loss. But is this truly a turnaround to profitability, or will it actually be profitable? These are questionable. That's why I told you earlier to look at the cash flow. If you look at the cash flow from operating activities, it's positive for the quarter. So in the second quarter, it's $100 million, and in the first quarter, it's $130 million. They're currently recording a surplus in operating activities. That's why these parts are gradually increasing, so there's not much left before net profit also turns positive, and it's a situation where the chances of turning a profit are very high. Then one thing we need to check here is that the operating cash flow for the second quarter is $110 million, and Yon Ansan is the total for the 4 quarters. All 4 quarters total, $390 million. So, the operating cash flow this company generated over the year is $390 million, but the net income for the same period on a rolling basis is a deficit of $62 million. There aren't many companies where such a big difference occurs. Of course, it does happen, but a difference of this magnitude is really significant. So, the net income is a deficit of $62 million, while the operating cash flow is a positive $390 million. If you look at this, the difference is nearly $450 million. Why is the gap so large? If you just consider operating cash flow, the company looks strong, but net income is still negative. This makes you question whether to invest. So there are actually 3 types of non-cash expenses that this company currently has. Depreciation, stock-based compensation, and content amortization expenses were reported, with content amortization being the largest. Let me quickly explain how content amortization caused this difference before we continue. This is called content amortization. In the case of this company, for example, if they produce movies or purchase movie-related licenses to show movies and attach advertising products to them, then when they produce a movie or buy the rights, actual cash goes out. They have to pay cash to buy it or invest cash to produce it. So on the cash flow statement, it shows as cash outflow in operating activities. Cash has gone out. But when we pay cash to buy movie rights or produce a movie, how do we record it? We record it as an asset, specifically as a content asset under intangible assets. So by spending money, by using cash, we secure it as a content asset. That's the concept. Because this content asset hasn't been sold or used yet, it's not recorded as an expense on the income statement. Even though the cash has gone out, it's not counted as an expense. Secondly, when it moves to the next stage and viewers start watching the movie or it goes into distribution, what happens is that the content asset gets consumed because it's being distributed. Because content has its own lifespan, what we call a shelf life. In Korea, we still air things like Jackie Chan movies during Chuseok or Lunar New Year, but content does have an expiration date. Usually, after a movie is released, it's hottest for about 1 or 2 years. Even if it's aired again after 3, 4, 5 or 6 years, the ratings drop and the chances of recouping the content costs get lower and lower. So when we first start distributing content, its value gradually decreases over time. So on the balance sheet, the value of content assets decreases, and the amount that decreases is recorded as content amortization expense on the income statement. Of course, as the value goes down, revenue is also generated, but both revenue and content amortization expense are recorded. But usually, when content sells well and has high ratings, most of the amortization happens in the first and second years. About 70% or more is amortized early on. When content is first released and sells well, content costs appear to rise sharply because amortization expense increases significantly. Even if sales rise, costs also increase, making it difficult to generate net profit. But if you look at the cash flow statement, pay attention here, there is no cash outflow, right? Because when you bought the rights or produced the movie, you already spent the cash. The cash flow statement is based on actual cash movement. Since you already spent it, distributing or streaming the movie doesn't cause additional cash outflow. The cash has already been spent, so no more leaves for the cash flow statement. On the income statement, the cost shows only as content amortization expense. So in the case of Lock right now, the big difference between operating cash flow and net income is happening because of this very reason. So what's happening is that as the company's sales have grown and it's gotten on track, the amortization expenses for the rights they've purchased or the content they've produced and distributed are increasing significantly. So because these costs are incurred, the company can't show a profit from operations. But on the cash flow statement, these costs aren't actually cash that's going out right now. The cash already went out when they bought the rights. It's already been dealt with. Because of that, on the operating cash flow, the amortization of content is added back to the operating activities. When I was covering the cash flow statement in the early days of my channel, I talked about the depreciation and amortization part, when dealing with operating cash flow. So if you don't quite understand this, I think it would be good to watch that video. So this is kind of similar to what we're talking about here. In the case of manufacturing companies, they also invest in tangible assets. If they invest in tangible assets, let's say they can use a machine for 20 years, then every year they record 1/20th of the cost as depreciation expense. But in reality, the cash for all 20 years was paid up front when they first bought it. They just allocate the expense as 1/20th each year. So when calculating cash flow from operating activities, we add back the depreciation expense to adjust for the difference between net income and operating cash flow. Because the cash didn't actually go out, we add back the amount of depreciation expense. You can understand content amortization expense in the same way. The money was already spent, when the content was produced, and as people watch it, the cost is spread out over several years as an expense. Although it's listed as an expense on the income statement, no cash leaves now. We add this back to operating cash flow, creating a big gap between net income and operating cash flow. So even if the net income is in the red right now, there's no need to worry too much about it yet. The key is operating cash flow. It's far more important. Focus on that. That's why for these companies that have turned profitable, price to cash flow ratio or price to sales ratio is much more important than price to earnings ratio. So if you look at the investment indicators for companies that have turned profitable, you'll see that price to earnings ratio keeps showing as a negative number. Of course, it's negative because their net income is still in the red. Then you can't really pinpoint when you should buy. So for companies expected to turn profitable, it's best to look at the price to cash flow ratio as the main indicator and use the price to sales ratio as a supplementary one. So when you look at the price to cash flow ratio, that's the price to cash flow ratio. This cash flow refers to the operating cash flow I mentioned earlier. It means how many times the market cap is trading compared to the operating cash flow. With price to cash flow ratio, it always results in a positive number. Previously, it was 50 times. Now it's 20 times, which is likely the cheapest. Then it goes to 32 times, showing these changes. So you look at this and judge whether it's a sufficiently cheap price compared to the past. And then if you look at the indicator called price to sales ratio, even though sales have increased now, it keeps dropping compared to the past. On the right, I drew the price to sales ratio chart for you. When it was very expensive before, the stock traded at up to 20 times sales. Even if it wasn't that high, it was traded at about 7 or 8 times. And then when the stock price completely crashed and dropped to the $30 range, the price to sales ratio was about 1.8 times. It fell to this point, then the stock price rose slightly and is now fluctuating between 2 and 5 times. So if you look at it in terms of price to sales ratio, it's still considered very cheap. So for companies that have turned profitable, it's better to evaluate them using price to sales ratio or price to cash flow ratio. That's how you should understand it. I'm going to take a look at this company's valuation and current supply and demand. The valuation is based on the quant valuation done by Chositak on our website. So according to our algorithm, if you look now, the areas marked with dotted lines are very undervalued. The stock price dropped down to the very undervalued lines and has come up a bit now, but it's still between very undervalued and undervalued. Just because it's cheap doesn't mean it's a good company. To consider a stock a good pick or give a trading signal, it needs a strong score, solid fundamentals, reasonable valuation, and favorable supply and demand. Even with strong fundamentals and valuation, don't buy if supply and demand aren't favorable. Even with the stock price increase, it's still undervalued by valuation. Next, you need to consider the fundamentals, which aren't very strong right now. Instead, it's at a point where it's turning profitable. And to see if this turning point is good enough, I looked at things like operating cash flow and recent sales growth. So in terms of fundamentals, the score is lower than what we would normally expect. It's low, but if you look at it just as a company turning profitable, it's actually not bad. If you think companies becoming profitable are too risky, remember, there's risk either way. Getting this right greatly increases the odds of the stock price rising, far more than just the basic chance of an increase. On the other hand, if the company fails to turn profitable, there are both possibilities that the company could go through a second round of decline. I know how to invest in blue chip or growth stocks, but with turnaround stocks, companies becoming profitable, you can decide whether to seek out these opportunities yourself. Today I chose Roku from the list of companies becoming profitable, but I'm not recommending Roku as currently profitable. I'm showing you what data to review and what steps to take when deciding on companies becoming profitable. So in terms of valuation, you could say it's cheap right now. From a supply and demand view, we check the exponential moving average chart showing the 20-day, 60-day and 120-day lines for a midterm outlook. If the 21-day crosses above the 61-day, it signals a midterm upward trend. Here, the stock price is near June 2025. At this point, a golden cross occurred, so the upward trend is continuing for now, and that trend hasn't changed yet. So for now, the part I'm paying the most attention to is how it breaks through the previous high of $100, and I think that's going to be a very important point. So for those who want to invest more safely, I think watching whether it breaks through the $100 mark could be a good strategy. Alternatively, if you believe the stock price will rise long-term based on various factors, you can buy early. It depends on each person's judgment and timing. If you ask me, I wouldn't invest in this company now. I believe companies that are growing are more stable than those that just became profitable. However, if you think that at least one stock in your portfolio could turn profitable, you could look for and analyze companies like this and make your decision. So it's good to remember that everyone's preferences, tendencies, and decisions can be different. There is a menu where you can find these companies that have turned profitable all at once. So to help you discover stocks, our service has something called an investment recipe that you can use. So right now we offer about 9 different recipes, and in the long term we plan to increase that to around 20. If you look here, when you go into growth stocks, you'll see the turnaround to profitability. As I mentioned, we divide them into 3 categories. Companies that turn profitable, then companies with even higher growth rates are called rocket growth stocks. Next, discovery growth stocks can also have high growth rates for both. But this category also includes companies that grow for a while and then experience a bit less growth. Growth stocks are considered in the short term, like over 1 year, while rocket growth stocks are looked at through the following year as well. So there are all 3 types of items. So I'm going to explain this using these. And today, if you click on the Turn to Profit menu, you can see the full list of companies that have turned profitable, and you can review what we've learned today. From those, you pick one and try following the steps on the screen in the order I mentioned. So if you're wondering whether to buy this company or not, and you want to study it a bit, it's good to buy about 1 share. If you think it's okay to buy, just hold on to it. And after 6 months or a year, you can see whether the stock price of this profitable company has really gone up or if it failed. If it failed, you can check whether the indicators improved but the price still dropped, or if the indicators got worse and that's why it went down. These things are great practical tools for you to learn from. Theory matters, but making your own decisions is more important. Then if you buy just 1 share and observe how the stock price moves, I think that kind of experience will be very helpful for you as you study investing. Now let's go to our website and I'll show you how to find companies that have turned profitable. If you look down here, you'll see a section called News Discovery. Click on Discovery, and in the middle there's something called Investment Recipe. If you click on Investment Recipe, you'll see recommended recipes and hot stocks. From there, if you select growth stocks, you'll find an option called Turned Profitable here. So if you click on Turned Profitable, we filter and show you all the companies that are expected to turn a profit at once. So you don't have to search for them yourself. I'll click Turned Profitable now. Then the list is currently sorted by market capitalization, so you just look through it in order of market cap like this. Biotech, Pharma, Citicals. Oh, this one is turning profitable. MicroStretch is also turning profitable. You can see it like this. Marvel Technology is also doing it. As you scroll down, you can see all the companies that are turning profitable. And shall we take a look at Reddit? Reddit recently showed a buy signal. I'm curious to see what will happen next. Scrolling down will show the earnings results below. In 2024, it went from $3.33 loss to $1.86 profit. I found all this for you. Then you just keep looking at how these companies will move according to that pattern. So if you found Reddit, then you also look at the sales growth rate like this. This year, 58%, next year, 31%, and 27%. That's fast, but that's how it is. Earnings. Per share is 1.86, rising 62% next year and 33% the year after. If they turn a profit this year and the valuation isn't too high, it could be a good option. That's how you judge it. And then I told you to look at things like cash flow. Then go in here and check the financials. You see the financial statements. Annualized is the sum of 4 quarters, and if you switch this to quarterly, it becomes quarterly, but let's just look at the annualized for now. If you look here, what I told you to check was the operating cash flow and free cash flow. The operating cash flow for Radish in March 2024 is in the red. And then at the end of June, that's June of last year. It became profitable and now generates around 400 million with free cash flow also at 400 million. That's the surplus they're producing. But let's take a look at the net profit. If you scroll up, the net profit has also improved a lot. It went from a $400 million deficit to now a $200 million deficit. Compared to Roku, this one is moving faster and is ahead. It's currently a leading tunnel hound stock. let's take a closer look. And I think we introduced Radisson once during our stock discovery segment. So we've talked about this company before. It's a community-based company. So right now it's improving quite rapidly, getting better quickly. And then there's the valuation, right? Whether it's cheap or expensive. In the past, Radisson was way too expensive at this point, so it wasn't a good time to buy. Now it's dropped again, and if it had dropped a bit more, it would have been undervalued, but I don't think it quite reached that point. At this point, and if you look recently after the earnings announcement and the updates, the fair stock price has completely jumped overall. So basically, if you look at it, the stock price here and the stock price here are almost the same. But on the left side, this is very overvalued, right? Because it was much higher than the company's value. Now, the reason is that the company's value has jumped, so now it's at a fair price. It's not just about whether the stock price increased or seems high or low. You need to compare it to the company's value to judge if it's cheap or expensive. So even though the stock price has gone up a lot recently, if you look at this company in terms of valuation, it's at a fair price. I also mentioned this in a recent video on Mijuchu. So I explained that fair value and target price are different. The fair value here is the reasonable price, and that's what we provide. But just because the stock reaches this point doesn't mean it can't go up further. This is the fair price, and the stock price just moves back and forth between here and there like this. That's how it appears on this chart right now. So just because it reaches the fair price doesn't mean the stock price can't go up. And just because it arrives at the fair price after a correction doesn't mean it'll rebound either. So it could drop even further. This valuation chart is great for judging if something is cheap or expensive. To see if it might drop further or rebound, check the exponential moving average chart I mentioned earlier. On the supply and demand side, this one is short term and this one is mid-term. Looking at the mid-term, it turned around here, and in the short term, it just turned around now. It almost disappeared for a moment after turning here, but now the momentum is picking up again like this. If you refer to this, I think it will help you judge whether it will stop at that point or not. The combination of fundamentals, valuation, and all of this is the trading signal we provide here. This is an artificial intelligence trading signal, and I didn't even know it would give a buy signal. It came out at $215 on August 11th, and now it's up about 1.8%. I'm curious about this too, how it's going to turn out. If you look here, the company's stock price was at the bottom, and that's when the valuation was low. And once it was clear that the company had turned around, that triggered a buy signal. After that, the price went up a bit, and now it's in a correction phase. From here, it could go up again in a second stage, or it could fall back down after another correction. If it falls after the correction, that means the momentum is broken again. A sell signal may also show up in trading signals. A buy signal doesn't mean you keep holding if momentum breaks, that's it. But if it rises, all three conditions are met. You need good fundamentals, attractive valuation, and improved supply demand, all three factors. Simply put, it's like a safe traffic light turning on, and you can think of that as being captured in the buy signal here. So if you discover it now and go in with the recipe I mentioned earlier, if you go into growth stocks that have turned profitable, you can see all of this. These are all stocks that have these features right now. You just need to pick one of these and do as I said. Companies like DraftKings also seem like a good choice. I sorted them by market capitalization, and for example, among the companies turning profitable with a good smart score, I want to look at the top ones, like first, second, and third place based on quality. Then you just need to click on this one, and I'll go ahead and click confirm. So Vertex Pharmaceuticals has the largest market cap and highest score, right? Next, Norwood Financial and Triple Flag. I'm not really sure what kind of companies these are. Vancouver, Marin, and then Reddit. Reddit shows up again. This one also has a large market cap and a high score. Next, Astra Labs, which we covered in our previous video, is also included here. If you look at it sorted like this, when turnaround companies succeed, their stock price shifts from a turnaround phase to becoming a growth stock. As you saw earlier, after turning a profit, the growth rate in the following year is very high due to the base effect. So if the turnaround to profitability is definitely successful, after about a year, it will become a growth stock. If so, its category changes. Some prefer to buy before it becomes a growth stock for higher profits, not just after it rises. For them, turning profitable is an earlier stage, but risk is higher since failure brings losses. Companies becoming profitable operate in a high-risk sector with high expected returns. So, if you can discover companies that are turning profitable by looking at the relationship between stock price and earnings per share, it will help you expand your investment ideas and find more promising stocks. If this video helped, please subscribe, like, enable notifications, support us, and comment. Thanks. Thank you.